Chapter 1, Investment Analysis. So the purpose of this chapter basically is to understand basic knowledge why people invest, how we measure risk and return, and what effects return has on an investment. So first question is, why do people save and invest? Simple. People will save money instead of spending their income on several reasons. So number one, they'll save to prepare for emergencies. They'll save money to plan for future needs like retirement or buying a house, children's education. They'll save money to grow their wealth. So these are the most logical things that people do. But on the other hand, we understand in economics that income is the income equation is given by consumption plus savings. At equilibrium, we can say the savings is equal to investment. So sometimes if income is not consumed, it is either saved or invested. So the savings and investment part is what we're looking at in this context. So why do people save? These are the reasons for emergencies. All right. On the other hand, why do people invest? They invest for many reasons. Number one, you invest money instead of keeping it idle to earn a return. You can invest in foreign currency or forex trading, which has become one of the things you as investment students should actually look into. It's an interesting, practical thing. Okay, it's not baiting. I would encourage you to look at it. Or buying bonds as well. You should also understand that investment will be to protect against inflation. So when you keep money, it reduces its value. You also want to build wealth over time. So the definition of investment simply is investment is a current use of money, which could be in savings, with the expectation of earning a return in future. So it considers the time, how long the money will be committed. It considers inflation, the expected rise in prices. It also considers risk, okay, the degree of uncertainty. So now, how do we measure this risk that we're talking about, the degree of uncertainty? So measuring of risk is done in different ways. So that types of returns that we must know. So we need to choose between investments. So to choose between investments we're undertaking, we must measure how much return they will give us. So returns are actually gains that we get from these very investments. They're often as a percentage. There are two types of average returns. We have what we call the arithmetic mean return, which is simply a simple average of multiple periods. And we also have a geometric mean return, which is simply an average that contains compounding. Okay, it's more accurate over years. So for instance, you can earn 10, 20 minus 10% over 3 years. Then when you average them, divided by 3, you're going to get 6.6%. So this is what we call an average mean. Okay, then geometric, you can use something more than 6.6% because of the compounding interest. So you may gain more than this average mean that you are going to get if you're using the arithmetic mean. Now, what is risk? Risk is simply what? The degree of uncertainty. So risk is measured in three main variables that we're going to look at. So we can measure risk in terms of variance, which shows how much return will vary from the average. It also can be measured through what we call standard deviation, which is the square root of the variance. It's much easier to understand. We can also measure risk in terms of the coefficient of what? Variation, which is the standard deviation divided by the return. It shows how much risk per unit you are having of your return. So the more variation you have, the more risk you are having. Are we together? The more variation you're having,
Yes, sir.
the more risk you're going to have. Now, the other terminology that we're going to make use of is the term required rate of return. What is our required rate of return? This is simply a minimum return that investors will expect to compensate for their time value of money, their inflation, and their risk. So it is hard to estimate because investment keep changing. It's hard to estimate because many options may exist with different risks attached to them and their returns. It's hard to estimate because the yield spread, the differences between the return and investments. So the yield spreads over time as well. So we should also look at factors that will affect our required rate of return. There are many factors that will affect our required rate of return, but we're going to look at the three main factors. There's what we call the risk-free rate, there's what we call the inflationary premium, there's what we call our risk premium. Okay, so our real risk-free rate is often tied to long-term economic growth. In most cases, we look at our treasury bills. And inflation rate, we are looking at what adds up to cover the loss for the purchasing power. And we have a risk premium, which is the extra return for taking on the risk. So the required return is simply risk rate plus uh, inflation premium plus the risk premium. If you're using the Iapm model, the risk-free rate or the expected return is simply the risk-free rate plus beta plus our risk premium, okay, which is the difference between the market risk and risk-free rate. We'll talk about this when we do our calculations later on. Are we following?
Yes, sir. Yes, sir.
Okay. So the risk premium will depend on a number of factors: the business risk, the financial risk, the liquidity risk, the exchange rate risk, the country risk, the systematic risk, which is measured by beta. And by now, I hope you understand what each of these risks entail. Quickly, what is a business risk? What is financial risk? What is liquidity risks? So when you're dealing with risk generally, it is the risk premium is the additional return an investor will expect from an investment that carries risk over a risk-free rate or risk-free asset. So it actually compensates for the types of various associated risks that we are going to, in this course, look at. So the types of risk, we have business risk, which is a uncertainty that is associated with the firm's operations and earnings. So this business risk includes factors like competition, market demand, the input costs, okay? The higher the business risk, it increases your risk premium. You also have the financial risk, which is risk that is related to a company's use of what? Debt financing. So firms that have high debt levels have higher what? Financial risk because of the obligation to meet their interest payments. We also know liquidity risk, which simply is a risk that an investor may not be able to sell the investments quickly at a fair price. So illiquid investments like private equity or real estate typically have a higher risk premium to compensate for the difficulty in converting them into cash. So liquid risk is the risk of failing to convert your assets into cash, in short. Exchange rate risk is simply the risk that affects investments exposed to foreign currencies. So these fluctuations in forex or foreign currency may affect your returns. So especially in multinational firms or foreign investors. So we also have country risk, which is simply risk that includes political, economic, regulatory risk in investing in a particular country. So these risks, for instance, tend to be higher in countries that have uh, instability. We also have systematic risk, which is measured by beta, which refers to a market-wide risk that cannot be diversified, like inflation, recessions. They are measured by beta. And we talked about beta being what? If it's at 1, it is moving along with the market risk. If it's more than 1, it's volatile. It's less than 1, it's less volatile. So these are some of the factors that affect what? Inflation. So we have what we call the um, SML, which is a security market line. What is the SML? It is simply the market line that shows the relationship between risk and what? The required rate of return. So you've seen faced before. What does it do? What does the um, SML measure? And how important is it for us to know? So the SML, which is a security market line, is just a graphical representation of the Iapm model. So it shows how the required return on an investment changes with systematic risk. So on the x-axis, we have risk. On the y-axis, we have the um, expected return or the required return. So here we have our risk, we have our expected return. Okay. And here we have our risk. So it shows the relationship between these two. We know that the higher the risk, the more the return. So that's as a positive relationship. So the key concepts here is that if you have a higher beta, your required rate of return will be higher because we know that as assets beta will increase, the systematic risk will also increase. So investors will usually demand a higher return when they're taking on more risk. So this movement along this curve, which we call the SML, represents the change in the risk beta for a specific asset. So the asset can move up and down, but in the overall market conditions like inflation, the investor, it may remain unchanged. And we also have the slope of the or the gradient of this so-called SML curve. Okay, this is a gradient of B. What does this gradient imply? The slope is or the change in the slope, it occurs when the investor's risk aversion will change. So if investors become risk averse, the market risk premium will increase. So it will make the curve steeper. But if they become less risk averse, the curve will become flatter. So when the curve becomes parallel, okay, or the parallel shift of the SML happens when there are macroeconomic levels that change in terms of inflation and economic growth. So when you have a rise in the expected inflation, the SML shifts upwards. So meaning there'll be a higher required rate of return. So when the curve falls, it means inflation has fallen, so it will drop downwards. So just briefly understanding this, it came in your test. I don't know, the test that you wrote was not complete. They only gave you components of it. Whether you forgot, I do not know. Usually very bulky.
Yes,
And
sir.
we also need to understand, yes, there's a question.
No, sir.
Okay. So in this course, the first chapter also talks about what? Um, preparing for asset allocation. So with the understanding, you need to decide how to invest into stocks, bonds, real estate, and other assets. And you need to make a decision that will depend on your goals. Okay. So these are the factors that you need to look at. So this chapter, you need to understand that there are different asset classes, or what we call financial assets and real assets. Okay, so under asset allocation, it's actually a process where you decide how you're going to distribute your investments across these different kinds of asset classes to balance up on your risk and your return. So the common classes that we have are stocks, where they have higher potential returns and higher risk. So bonds have lower risk, but they have steady income. The real estate, these are tangible assets that you have. They'll provide you with income and they'll hedge you against inflation. Other assets that you need to know, mutual funds, uh, ETFs, crypto, or private equity. So what are some of the factors that will affect your asset allocation? Goals. What goals are you looking for? What are you investing for? Is it retirement? Is it a home purchase? Is it education? And in these goals, are they short term or long term? If they're short term, you need to play safe. Okay, you need to invest in more liquid assets. If it's long term, you can tolerate more risk because there's higher growth. Okay, the other factor that affects your asset allocation is your risk tolerance. How much risk are you comfortable with? We know that there are aggressive investors who take on more stocks. Okay. If you're a conservative investor, you invest more in bonds and cash equivalents. And also need to look at the time horizon. How long will you need? How long until you need the money? So if you need a longer time horizon, the more time you will take to recover from these market downturns. You will want to invest in more stocks. If you're looking at a short time horizon, you prioritize capital preservation. So you want to invest in more bonds or cash. So asset allocation is dynamic. It evolves around your life. So depending on what kind of goals you have, it will determine what you're going to look at. So in this chapter, I'm just summarizing the key elements of the chapter. Also talks about the purpose of investing. Okay, why are you investing? Why are you borrowing or saving? So these are the questions that chapter one looks at. So for you to take investment analysis, you may need to understand the purposes of your undertaking. So some case studies will come for you to give an advice based on those factors. So questions will come on a case study to explain what kind of strategy one person must take. So the purpose of investing we talked about is to grow wealth over time, to beat inflation, or to achieve goals like retirement or homesteading. And why do people borrow or save? They borrow for tuition, they borrow for basic needs. Okay? They'll save for emergencies or future expenses. So that is common to do. So the saving patterns will range. We have the saving pattern depending on the age range. If somebody is 20 to 30, then they're usually borrowing for school, for car, likely. But 31 to 40, they are starting now their life. They want to grow their income. From 40 to 50, they'll save more, all right, to peak their career earnings. 51 and above, that's the maximum saving. They want to prepare for retirement. 61, they withdraw their savings for to now enjoy their sweat. Now, are we together?
Yes, sir.
So we've also talked about the variance is measured by standard deviation. The higher the variance, the higher the risk. And we talked about three components of required rate of return. What did we say? We have risk-free rate, which is based on a return without inflation. We have inflation premium, which compensates for the loss in the purchasing power. We also talked about risk premium, which is a reward for taking on extra risk. So we also need to know what affects our normal risk-free rate in RFR. Our normal risk-free rate, what affects it? The real risk-free rate. So inflation, which is more volatile. And what are the five factors that affect risk premium? What are the five factors that affect risk premium? Or the five types of risk, what did we say? The business risk,
Liquidity,
liquidity,
business,
business
financial,
financial, okay,
exchange,
exchange, correct, okay. So
Country.
now, and country. What is country risk? What did we say is country risk?
Political, regulatory issues.
Okay, exactly. So now let's go to computation of our variance and standard deviation. So we'll look at one of the questions in the examples. Sometimes it gets questions exactly as they are. So the variance is given by probability times possible returns and expected returns. Then we have that. So we are given to consider an example here where the probabilities and the expected returns. So how do we find the expected return? We just multiply the respective probability times the possible return. Then you sum up. So this times that, we get that. This times that, we get that. This times that, we get that. The total here is our expected return, which is 0.07 or 7%. Okay, let me start from what you know to what you don't know. Are we clear on how to calculate our expected return, possible probabilities, and the actual return to multiply them and sum them up? This we know, isn't it?
Yes, sir.
Then we go to calculating our um, variance. So our probability, our return, okay, the total we found 7%. 0.07. So from each of the returns, we're going to subtract this 0.07. So 20 minus 7% is 13%. This is how we're getting this. Then we square it, we get 0.169. Then you multiply by the probability here, 15%, which is that. Again here, minus 20 minus 7%, it's minus 27%. You square it, we get this. Then you multiply by 0.15, we get that. This is 10 minus 7%, that's 3%, is that we square it, multiply by the 70, we get this. Then the total here that we get is what our variance. So variance 0.014. Okay, then we square root it, we get so now to find our standard deviation, we square root this very answer to get from the variance to get our standard deviation. So that is that. So our standard deviation is 11.87 percentage. So we have three variances we talked about: the actual variance, types of risk, standard deviation. And who remembers how do you find the coefficient of variation? How do you find our CV?
See, we have the standard deviations, the two standard deviations under there, and then yeah, you put into the
Over the
to the
expected
expected
return.
return.
Yes. So we'll find our standard deviation, which was 11% over our expected return, which is 7%. And multiply by 100 or leave it as it is. So the higher the CV, the more the what? The more the risk attached. Okay, so there's also times when you're not given what? Probabilities. So we've been given information below from the New York Stock Exchange, where you've been given the following information on the annual rate of returns. Okay, so we have 2003 to 2007. Then here we have the returns here. So we need to calculate our expected return. So there are two ways in which we can answer that. Okay, so here we assume that there are equal probabilities. So the total probability must be 100%. So 100%, how many years we have? 1, 2, 3, 4, 5. So 100% divided by 5, what do we do? 20%. So here our return will be 0.2. Meander, you had asked this question, right? Whenever we don't have
Yes.
probabilities, we just divide the number of years. Then you apportion the equal probability. Is that clear? So we're going to have 20%. That's where 0.2 is coming from. Okay. So
When you
we're going,
say, so just a question around that, what you're currently working on. You said if you don't have the probabilities, you divide what? The number of years by 100, or 100 by the number of years.
1, 2, 3, 4, 5. What
So
is
in that case,
5 into
that would be
120.
20.
that is 20. Okay. That is
And then you
20.
distribute that equally across the different years.
Okay. So 20. So we want to get, we assume that there's equal probability. So and the expected value, which is our R, should be the sum of the individual observations in that case. Okay. So we have this is our original question here. The annual retains 7%, that and that and that. Okay. So how many quarters are there in a year?
4.
Four.
4
Okay.
quarters, yes, sir.
4 quarters in a year. Very good. So how many quarters? So we have 20 zero. So how many quarters are in all these years? 2, 3, 4, 5.
5 by 4. 20.
20, yeah?
Yes, sir.
Okay. So these are 1, 2, 3, 4, 5. So 100 divided by 5, we're going to get 20. Okay. Then again, what is 20 divided by 5? 4%,
It's 4.
is it? So 4%. So the average, 4%. So we're going to subtract 4% from the 7%. That's a 3%. 11% minus 4%, 7%, minus 4% minus 4%, 8%. Then we square this figure and multiply by the 4%, which is the probability. Question again. We have 5 years in here. We divided by 100 by 5 to get 20%. Why are we dividing again by 5 in this case when we already divided the 100 by 5?
Because I was thinking maybe when we get to 20, the 20 is 20%.
Mm-hmm.
And then when we reduce the 20% into yeah, then it gives us 0.2. Maybe the other way, maybe we're assuming the probabilities add to 1. And then 1 divided by 5. I don't know.
So we divided the 100 by 5 to get 20%, which is this 20%. Then again, we
Yes, sir.
divided this 20% by 5 to get 4%. So why are we dividing this 20% by 5? That's the question. So remember, we are assuming equal probabilities and the expected value in the case of the
Yes, sir.
mean. Okay, we're looking at the mean value, R. Okay, so of the series is the sum of the individual observations in the series and divided by the number of observations. So why are we dividing again by the number of observations, the 20%? So in this case, we're using 4% throughout, 4% throughout, 4% throughout. And 4% throughout is giving us an average of 20%. Why are we using that?
This is just a world guess. I'm not seeing the relation, but is it because there are 4 quarters in a year?
Yes, if there were 4 quarters in a year, we would have divided by 4 here to get 5%.
Oh, you used 5. Okay.
Okay, so this is where they're using the 20%. No one is giving me the response. Okay, but ideally, it's just supposed to end there, where you divide the number of days, which is 100% by 5. So we use 20%, 20%. So up to now, I don't know whether this was an error or it's another treatment, but it's supposed to be 20%, 20%. So you multiply this one by that, this one by that, this one by that, this one by that to get the what? The expected returns. So the expected return actually, so this is a probability we're going to look at. Multiply this by that, this by that, this by that, this by that, this by that. The total is called our expected return. So this expected return here, I think that's one column that they didn't show, which is giving us what? 0.04. 4%. So we're going to subtract 7% minus 4%, we get that. Then we square it and multiply by our 0.2.
Probability.
Okay, there should be another column there. You get it now, right?
Yes.
Do you get it? It only makes sense like this. So these are 5 years. So you divide 100 by 5, which is 20%. So you multiply this for bit and the actual return, you get your answer here. This return by the actual return, you get your answer here. This by that, you get your actual answer there. The total that you're going to get there was a 4%. Then you subtract 7% minus 4%, 3%. You square it, 0.9%. Times the initial probability of 20%, you put it there. So the total value you're going to get there will be what? Our variance. Okay? And after you get the variance, you square root it to get your standard deviation. I think the key concept we're getting there is that you need to understand that some of the returns that you're going to have are going to have probabilities, the other ones may not have probabilities. So you should follow that sort. Is that clear? Then,
Yes, sir.
I have a question.
yes, please.
Why, if you look at that table, right, and you just do the arithmetic mean of the R's, where you just add all of them and divide by 5, you will get a return of 0.04.
Oh, it's the same because you average this. So,
Okay, so let's assume for a minute,
mhm,
though the items in red don't exist, right?
mhm.
Okay. So if we take R and we just add all of them, we sum all of them and divide by 5, it gives us our expected return, which is the R bar, 0.04.
Okay.
And similarly, if we go ahead and do R minus R bar, yes, we'll get those figures, no problem. If we square them, we still get those figures. Now, if we add the R minus R bar squared,
Mhm.
and then we divide by 5,
Mhm.
will we not get the variance?
We will. It's another, I think, quicker way that they're doing it. So they've skipped the columns of multiplying the probability since it's even. Okay, becomes relevant to redistribute those ones there if the probabilities are not even. So after getting R minus R squared, even without the probability, this particular answer divided by 5 gave the variance, which is this part here. Interesting. So you hear what she's saying. She's saying in this case here, even without getting the probabilities here, we can total up this. All right. So what you're going to get here is about 8%. It's about 20%. So you're going to get 0.20. So this is the total of the returns themselves. So just divide this by 5. So which gives us what? 4%.
0.04.
Yes. Then again, if you're dealing with equal averages, you can just now start subtracting. This minus 4%, we get that. This minus 4%, we get that. Okay, we square, of course, this side. This minus 4%, we square this side. The total that we get here is not the variance, but when you divide by 5 again here, we get our
Yes,
variance 0.057. Then we square root it, we get this answer. So correctly said.
yes, sir.
Okay, so to find the coefficient of variation, we said it's simply the standard deviation divided by the expected return. So in this case, our standard deviation was 7% and our expected return was 4%. So dividing the two, we're going to get our coefficient of variation, which is 1.89. Any questions so far? Awesome. Okay, so this is how we calculate. So the notion here is that if you have a higher CV, it means there's a higher what? Risk.
Yes.
So if you're comparing two activities, CV1 is 1.8 and CV2 is 0.9. So based on this, which of the investments would you pick? Investment one or investment two? So that is relative to the kind of investor in question. So there is no clear-cut answer to ascertain which investor or investment is good. So depending if it's a risk seeker, they'll go for investment one. They're aggressive, okay? If you are a risk averse, okay, you go for investment two, which most of the investors will go for because the relative dispersion is higher in the first one than the second one. So the ability to attain your expected return is more on the second investment. Is that clear?
Yes.
Yeah. So based on that, I need you to attempt this question here. Question number 1 and 2, you based on what we have discussed. So you may have to look at that.